Welcome to this month's update on housing market conditions, brought to you by onthehouse.com.au. This month we launched the new generation CoreLogic Hedonic indices, which provide a further improvement on the market-leading Hedonic valuation model that CoreLogic's been using to measure the housing market since 2006. The latest housing market results showed dwelling values held firm nationally, with capital city dwelling values nudging 0.1% higher over the month, while regional values slipped 0.2% lower. The flat result provides further evidence that the housing market is losing steam and is likely moved through the peak phase of its growth cycle. In fact, based on a rolling quarterly rate of growth, the housing market moved through its peak rate of growth in November last year, when dwelling values were rising at the brisk quarterly pace of 3.7%. Since that time, the quarterly rate of growth has eased back to just 0.5% over the 3 months ending August 2017. That's the slowest rolling quarter of growth since June of last year. The slowdown in growth conditions is most visible in Sydney, where housing values had previously been surging higher. Since values started rising in early 2012, the typical Sydney dwelling has seen its values rise by 75%, equating to an approximate dollar value of gain of $521,000. Sydney's rolling quarterly rate of growth peaked over the 3 months ending October 2016, when values jumped by 6.3%. Since that time, the rolling quarterly rate of appreciation has consistently eased, reaching the current rate of just 0.3%. Growth conditions are also easing in Melbourne. However, Australia's second largest city appears to be more resilient to a slowdown. This is evident in our Hedonic index results, as well as auction clearance rates, which have consistently held above 70%, and inventory levels, which remain close to historic lows across Melbourne. A variety of other measures have softened in line with the easing in capital growth. Auction clearance rates have found a new floor around the high 60% mark, where they've held consistently since early June this year. Average selling time is also starting to trend higher, and inventory levels are rising, providing buyers with more options and reducing some of the urgency that some buyers were feeling when stock levels were so much lower and properties were selling much faster. Growth in investment lending appears to have peaked close to the same time as the rate of home value appreciation in December last year, when investor-related credit growth was increasing at 0.8% over the month. Since that time, the monthly trend in investment-related credit growth has halved, reducing back to 0.4% in July. The Melbourne housing market has seen the pace of capital gains slow from the highs of last year. However, the market seems to be more resilient compared with Sydney to slower conditions. The peak rate of growth was in November last year, when Melbourne dwelling values were rising at the quarterly pace of 3.4%. Since then, value growth has remained strong, but it's eased back to 1.9% over the 3 months ending August 2017. Auction clearance rates continue to track above 70% across Melbourne, and private treaty sales are taking just 31 days on average to sell, reflecting a strong seller's market. Overall, slower growth conditions in Sydney and to a lesser extent in Melbourne are likely to be a welcome evolution of the housing market's performance by policymakers such as the RBA. So far, the cooling trend has been very gradual, implying that macroprudential policies are having a flow-through effect on housing conditions. The growth cycle in both cities has run for 5.5 years now, providing a substantial wealth boost for homeowners, but also creating much frustration for those who don't yet own a home. Sydney and Melbourne dwelling values have increased by 75% and 56% respectively since the growth cycle commenced in early 2012. However, growth rates have been far more moderate across the other capital cities. The policy settings around investment credit growth and new interest-only settlement targets have seen credit policies tighten and pushed mortgage rates higher for both investors and interest-only loans. These disincentives are likely to continue to weigh down investment demand, which will have a much more pronounced effect in those markets where investors are most concentrated. New South Wales has the heaviest bias towards investment, with 58.5% of the value of all housing finance commitments being for investment purposes. Clearly, tighter credit policies and higher mortgage rates for investors are dampening the Sydney marketplace more than others. Another contributing factor to slower home value appreciation is the high price of housing relative to incomes, particularly in Sydney. Affordability barriers are preventing some prospective buyers from participating in the market. The recent availability of stamp duty concessions in New South Wales and Victoria is likely to provide some support for first-time buyers. However, it's not likely that the rise in first-time buyer activity will completely offset the demand gap left by fewer investors. Overall, the outlook for Australia's housing market depends on a broad range of factors, including local economic and demographic conditions, as well as supply factors and credit policies. However, if the current trends continue, Sydney dwelling values could start to drift lower over the coming months. Historically, a negative shift in home values has followed every growth phase, so it's reasonable to expect a period of moderate value falls following such a sustained period of strong capital gains. With the spring selling season kicking off in September, it will be interesting to monitor the impact of higher inventory levels on the Sydney and Melbourne marketplace, especially given evidence of slowing growth conditions accompanied by stock levels that are already higher than what they were a year ago. If you'd like to keep a close eye on housing market conditions, the best place to keep up to date is the CoreLogic website at www.corelogic.com.au. You can also find detailed information about our recently upgraded Hedonic index, including methodological white papers and questions and answers.